This is not financial advice. I'm recording my thoughts about Crocs Inc. Its stock is currently trading at about $92 with a market cap of about $5.7 billion. Its PE is about 8.84 and the forward PE is about 7.36, which looks very cheap. First of all, when we look at a PE of under 10 for a company like Crocs, which has gross margins above 55% and has net margins close to 20%, and it's also growing in the double digits, we have to dig deeply into their financial statements and how their business is doing to make sense out of it. Just because the PE is under 10, it doesn't mean that automatically the stock is cheap. And in this video, I'm going to talk about Crocs' business model. I'm going to go over some numbers, and finally I'll do a valuation to determine whether this is a good entry price or not. Let's begin with Crocs' business model. As you can see on the screen, there are two brands. One is the Crocs Inc. itself, and the second one is Hey Dude, which they have acquired for close to $2.5 billion. Crocs itself is a world leader in innovative casual footwear for women, men, children, combining comfort and style. A lot of us know about Crocs. And they acquired Hey Dude, and that company designs comfortable, versatile, and accessible footwear and accessories. Mostly they deal with shoes. So Crocs is a retail business, and manufacturing, distribution, and marketing are its biggest challenges. Let's now move on to the numbers. As you can see on the screen, the past 12 months, the revenue is about $3.9 billion. Based on the market cap of $5.72 billion, the price to sales is under 2, which is actually cheap. And when we look at the net income for the past 12 months, it's about $669 million. That's almost $160 million per quarter profit. Remember this number, $160 million per quarter. When we look into the PE of 8.84, that's definitely cheap, but there are two major reasons for that. One is that they have high debt, and the second reason is their growth rate is decelerating significantly. Let's quickly look at their income statement in the most recent quarter to understand their gross margins, net margins, and stock dilution. As you can see on the screen, in the most recent quarter, they made about $1.07 billion of revenue. The gross profit is about $621 million, and that represents 58% gross margin, and this is for a retail business, so that's extremely impressive. Just for reference, company like Nike has gross margins in the order of 40 to 45%. So we can understand Crocs business is significantly more profitable than the likes of Nike. And just for reference, Crocs is close to a $6 billion company and Nike is $150 billion company. So that's almost 25 times bigger. And when you look into the income from operations, we have to deduct the operating expenses from the gross profit. So we ended up with $318 million in one quarter, and that's really impressive. So now let's move on to the net margin. The net margin is about $212 million, and that represents 20% net profit margins. That's actually very impressive, by the way. For a retail business, if you can get to 20% net profit margins, that is extremely impressive. But their operating margins are close to 30%. Remember, they made $318 million and ended up with only $212 million. So what happened to this $100 million? When you look into the red line where I have pointed out the interest expense, that's close to $43 million. So they paid an interest expense of $43 million, and that's because of their high debt. When they acquired Hey Dude, they paid close to $2.5 billion, and almost all of that came from debt. Since we are in a high interest rate environment, they're paying close to $40 million a quarter towards that debt. And that's creating a dent in their profitability. With respect to number of outstanding shares, they stayed at close to 62 million for the past 1 year almost. So even though this company is making a lot of profit, they're spending more money on repaying that debt than purchasing the shares back. And that's one of the challenges that the company is facing. They're balancing the debt payment and buyback of shares to make sure that investors are not hurt significantly. So let's now quickly look at how they are doing as a business with respect to revenue growth rate. As you can see on the screen, in the most recent quarter, they grew their revenue by about 11.2% to make that $1.072 billion of revenue. In the previous quarters, their average growth was more than 33%, and all of a sudden they posted 11.2%, and That's what spooked the investors and the stock fell significantly. And this revenue deceleration is not specific to Crocs. A lot of other retail companies like Dick's Sporting Goods, Nike also suffered from the same problem, right? Within this $1.07 billion of revenue, Crocs brand made about $833 million. So that's almost 75% of their total revenue. And the Crocs brand itself is growing at about 13.8%, and rest of the 25% is coming from the Hey Dude, which makes shoes, right? And if you notice in this highlights, they did not say how much Hey Dude brand has grown. They said, okay, direct to consumer revenues grew 29.7. Quickly look into what happened with Hey Dude. That was given in another screenshot, as I'm showing on the screen. The Hey Dude brand could only increase its revenue by 3% year over year. And that is a significant deceleration, and that has also contributed to the overall deceleration in growth. They're also giving a reason for this deceleration, and they're saying that the wholesale revenues declined 8.4% to $148 million, following pipeline fill in the same period last year. So it looks like the wholesale buyers, they have a full warehouse, so they do not want to reorder until that stock is gone. So that explains the revenue deceleration, but they could have done a little bit better than that, right? Now let's quickly look at the balance sheet. As you can see on the screen, the cash and cash equivalents are $166 million, and the long-term debt is about $2 billion, and they're making a lot of interest payment towards that debt, and they want to reduce that debt. And that's one of the reasons the company has been saying that we will continue to methodically balance debt repayment and share repurchases as we approach our long-term net leverage target of 1.0x to 1.5x. Currently, they're at 1.8x. So there is a long way to go for Crocs to make those payments towards that debt, and most of their profit will go to repayment of that debt. And they do not pay a dividend, and they cannot dedicate too much money for their share buybacks. So that's one of the reasons that their share repurchase activity has stalled, and that has also upset the investors. Before we move on to the valuation, let me show what they are guiding for this year. They are guiding for close to 12.5 to 14.5% revenue growth this year, and there is a note there that's actually based on constant currency basis. So the actual revenue growth would be lesser, but they're saying they can get close to $4 billion of revenue this year in 2023. Now let's move on to the valuation. I'm going to show two cases, one with reasonable assumptions and the other one with great execution. As you can see on the screen, in the reasonable assumptions case, the revenue in 2022 is about $3.5 billion, and I'm assuming a revenue growth rate of 7.5% for the next 5 years. With 7.5% year over year growth, they can make close to $5 billion of revenue in 2027, and I think this is actually conservative because this year they're saying they can get close to $4 billion of revenue. So they have 4 more years to make that extra $1 billion, to make that $5 billion of revenue. And the net income margin, I'm assuming about 18%. In the most recent quarter, they made close to 20%. Remember that their gross margins are above 50%. So they can easily make close to 20% net profit margins. And also note that their current net profit margins are suffering because of the interest payment that they are making towards their debt. And as the debt comes down, the interest that they have to pay will also have to come down, and their net profit margins have to increase. But I'm still keeping the same net profit margin of 18%, with which they'll make close to $900 million of net income in 2027. For a company that's growing in the 7.5% range and 18% net profit margin, I can easily assign a multiple of 15 because that's a cash cow multiple. But since Crocs has a lot of debt, they're paying it down, but they will still have significant debt even in 2027. Because remember that they're making $160 million profit a quarter and close to $600 million of net income in a year. So they can use close to $300 million to pay that debt back, and maybe another $100 million for their capital expenditures. Remember that they are still in the growth mode. This is a retail business. They have to invest a lot of money in the distribution centers, manufacturing, and also marketing. So they will not have much left for share buybacks. And I'm going to show that when I show you the number of outstanding shares. So with a multiple of 12.5, which I think is very reasonable, they will be worth about $11.3 billion in 2027. With respect to the number of outstanding shares, currently they have 62 million outstanding shares, right? And that did not change since 1 year because they're focusing on paying that debt back, and also they have close to $190 million of capital expenditures. I think they are doing something in Las Vegas with respect to distribution centers. But I'm assuming that they would buy back $800 million worth of stock in the next 5 years. They have authorization to buy back close to $1 billion, but I'm only assuming $800 million. With that, they will have 53 million outstanding shares in 2027. When I divide the $11.3 billion of market cap with 53 million outstanding shares, I get a stock price of $212 in 2027. Currently, they are at $93, right? So that's about 128% gain in 5 years, which is extremely attractive. Now let me show you the great execution case in which they can grow their revenue by 10% year over year. I think this is possible. The market has to come back, and Crocs has the brand value. With 10% revenue growth year over year, they can make close to $5.64 billion of revenue in 2027. I'm assuming a net profit margin of 20% this time, because as they get bigger and bigger, they can also get more efficient, and the operating expenses may not increase proportionally, right? So that's why I assume 20%. With that, they will make close to $1.13 billion of net income in 2027. That's growing in the 10% range and has a 20% net profit margin. I can comfortably pay a multiple of 15 plus. But I'm assuming 15, with which they will have about $16.91 billion of market cap in 2027. I'm keeping the buyback same, with which the stock price in 2027 would be about $317. Currently they're at $93, right? So that's about 241% gain in 5 years, and that's more than tripling our money. So this is also extremely attractive, but this requires great execution. In conclusion, with Crocs, I'm seeing 128% gain in the next 5 years in the reasonable assumptions case, and close to 241% gain in the great execution case in the next 5 years. So both of these valuations are very attractive. I think Crocs is a buy at this stock price. Remember that this is not financial advice. Even though this is very attractive, I'm not buying at this stage because I don't have enough money. One risk I would like to point out is competition. There are a lot of copycats in the market now, so they can deter Crocs growth rate. I assumed only 7.5%, which I think is very easily achievable by Crocs, but we don't know the future, right? So if the competition can really stop Crocs from growing significantly and also squeeze its margins, then they cannot pay off the loan as fast as they can. They cannot get to that 1 to 1.5x leverage ratio, and the stock buybacks will not be as significant as I have shown, and that's going to get us subpar returns. But still, I think in my base case, I think I'm already conservative, and Crocs at $93 is a buy, and I think whoever buys this at $93 will beat the index in the coming 5 years, in my opinion. Again, this is not financial advice. I'm not qualified to give financial advice. Let me know your thoughts in the comments. Thank you so much for watching.